And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Hope you're doing well, taking a little bit of time for yourself. And if this is the first time to our radio show or to our podcast, I just want to say welcome to the program. This radio show and podcast is really, we're focused on the retiree. We're focused on helping you get as much wonderful experience and peace of mind out of retiring as is possible. And how do we do that? Well, I think that there's two priorities for most every investor, every retiree that's out there, every American. And that is, number one, we want to reduce our risk to our principal, what we work so hard to save. We want to be able to make certain that that money never disappears. Because what's the number one fear the retirees have today, more than dying? That's right, it's the fear of running out of money before they run out of life. So we've got to make some changes within how we invest our money in order to be able to make certain that we are in that position where we don't outlive our principal. Number two is just as important, maybe even more so important, and that is, how do we get more income out of what we've worked hard to save? You know, the general success of the average retiree in America today, the things that they get to experience, the places that they get to go, that's based upon the amount of income that they have coming in. And not every person in America, in fact, 80% of Americans don't have pensions. And so today we're going to be discussing, the elections. We're going to be discussing interest rates. We're going to be discussing the changes that are likely to come down the pike at us and how it's going to affect the economy, how it's going to affect the market. But I'm also going to make certain that at the end of this program, we are focused specifically on what your priorities and objectives are to keep you focused on the things that are going to help you become the most successful retiree. So let's begin. Now, if you haven't gotten a copy of my book, The Capitalized Life or The Capitalized Retirement and Life, I really encourage you go out and get a copy of my book. This book has been written not to talk down to you, but rather it is designed to edify you, to teach you, to be able to show you in plain English language the things that you can be doing today in order to be able to help secure your retirement tomorrow and give you the income that you deserve, the peace of mind that I believe every American and every American retiree deserves. It's at every major reseller, Amazon.com, Barnes & Noble. It's fairly priced, something that you can buy, something that you can read, something that you can mark up and underline and highlight. And then when you're done, pass it on to a friend that could use the same kind of information. So let's get started. Today, we know that we've had so many things that have transpired in the last 30 days in America. It's hard to squeeze all of it into today's program, but we're going to try. And the first thing that we have to discuss is the big elephant in the room, no pun intended, and that is the fact that we've got the 45th president now becoming the 47th president. With 295 electoral votes, it was a pretty overwhelming, I would say, result coming from the American people. And in this case, we already have some degree of familiarity with President Trump, but we know that every time we have a president, it comes with new ideas, new initiatives. It comes with new agendas. And so we're going to be discussing some of those things. I have to say that if you've been observing the stock market over the course of just the last few days after the election, you know that the stock market seems to be pretty enthusiastic, with the Dow Jones and the S&P 500 being up over 4% just in the last couple of days after the election was really profound. It was an immediate increase in growth, and it was something that we haven't seen that kind of a reaction in a very, very long time. So what does this likely mean? I mean, what is the stock market seeing out of the future President Trump taking office in 2025? Well, I think First and foremost, there is an awful big driver of growth in America that is hinged and connected to taxes. And we know that right now we're functioning as a country under the Trump tax plan. And we knew that in 2025 there was going to be the likelihood of potentially the sunset provision. And, we were going to have a lot of debate about the Trump tax plan. And likely they were going to be, amending it or doing away with it. Well, with President Trump now being reelected, it's likely with the majority in the Senate that we're going to be seeing much of a change within the Trump tax plan. In fact, I think that not only are we going to see that he tries extremely hard to try to be able to keep things on the level, but we're going to see that he's going to even double down and try to increase the tax mitigation within the Trump tax plan. We're going to likely see that capital gains are going to stay the same. We know the capital gains are very important to all of us because if we have, say, real estate, you remember that just before the last election that President Biden had suggested that he was going to increase capital gains taxes to around 40%. And what happened? We saw Americans selling real estate like mad. We saw the real estate market heat up, and that wasn't necessarily because they just felt it was a good time to sell. Of course, that may have been the case with interest rates going to zero. But the reality is that a lot of real estate owners were selling because they were so afraid of paying an exorbitantly high capital gains tax on the difference between the cost basis, what they bought the real estate for, and what they were able to sell the real estate for. So the good news is that we probably won't see an overheating of the real estate market. We probably won't see a lot of selling of stock, primarily because there's not much reason to. We know that the capital gains tax rate is probably going to stay pretty subdued and pretty normal as a result of him taking office next year in 2025. We know that Social Security has been a big topic. It always is. Every single time there's an election, we know that Social Security is always discussed, how it's financially burdened. There's a lot of stress on it. And even immigration found its way into the conversation about Social Security because if you give amnesty to individuals that are not legally here and you also give them a Social Security benefit that they never technically worked for, well, that's just adding more people and beneficiaries to that account, and that's going to create more of a burden. But one of the things that I thought was extremely interesting is that President Trump is suggesting, and of course we all have to take this with a grain of salt. We know that many politicians make promises, but whether they can actually get their agenda forwarded, that's another thing. But he wants to see that Social Security is no longer being taxed. And we know that right now, the tax rates on Social Security are pretty burdensome. If you're a married couple filing jointly and you've got $44,000 of household income, and all of a sudden you end up turning on Social Security. Now, you know that the vast majority, 85% of your Social Security is now includable for income taxation purposes. And so a lot of people heard this idea that Social Security might not be taxed anymore. And man, that was an incentive for them because for many Americans, that's really the only reliable source of income that they have coming in during retirement. And then, of course, we have the interest rate cuts. Now, this is something that I think we need to pay very careful attention to because we know that President Trump was the one that really got Jerome Powell into his position as the chairman of the Fed. And we now know that President Trump really isn't very satisfied with Jerome Powell. We know that he's made many, many comments that he regrets his decision to put him into the Federal Reserve. Well, if we've been paying attention to the news, we know that Jerome Powell knows how well President Trump likes him. And he knows that when President Trump comes into office, there's probably going to be a butting of heads. And I think that the primary issue here is that Jerome Powell is a very even-keeled individual. I think many of us would suggest that the Federal Reserve should have cut interest rates before they did, but nevertheless, they're now on track, and they are now cutting interest rates as they suggested for so long that they would be doing. But I just question whether or not the Federal Reserve is cutting interest rates as quickly as what President Trump would want them to cut. And the reason being is this. We know that when interest rates decline, when interest rates go down, that fuels the GDP. We know that that fuels the economy. It gets the economy moving. Think about it. When you had the pandemic back in 2020 and you shut everybody home, send everybody home, and you shut the world down, well, that's not good for the economy. It stalls out, right? Well, now we're kind of experiencing the fact that the Federal Reserve has raised interest rates 11 times. They feel like they've slowed the economy down enough, and now policy has reversed. Now it's time to start taking the foot off from the gas pedal and putting it back onto, or off from the brake pedal and putting it back onto the gas pedal. So in this case, my hunch is that President Trump, as president, is going to want to see the Federal Reserve cut interest rates faster, or maybe faster and bigger. And in many respects, we have to be careful of that because we do not want to have another spike in inflation. We don't want to be paying, $10 for a pound of bacon. We want to be able to see our economy grow, but we want to be able to see that economy grow very slowly and very steadily without any major spikes. So that's going to be interesting to see. Now, again, if you've been paying attention to the Federal Reserve, we know that in October they cut the interest rates essentially by 0.5%. I think that they were kind of overcompensating because lagging economic data suggested that they should have cut interest rates a little sooner than that. But then we know that we just got the last rate cut in 2025 or 2024. We may get another one. It's kind of unlikely, but we saw that the November rate cut was 25 basis points. And so the market, I think, is responding to that as well, because when you cut interest rates, you're helping to promote corporations now to go back out and to borrow money in order to be able to expand their business. And when you think about it, when interest rates come down, you start to think about buying a new car and financing it or building a new home. As the business owner, I think about borrowing money to help expand my business. And so this is something that, of course, I think President Trump is all in favor of, having low interest rates, because that's going to be the catalyst to help take this economy to the next level of growth. That's something that every president really wants to see. Now, we're coming up to our first break, so sit tight. We've got a lot to discuss. We're going to come back and we're going to be discussing really staying focused on your goals despite this change of administration and what it means for you and what we need to be remaining very, very focused on. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to the program. Today we've been discussing so many of the things that have happened in America and to Americans in the last 30 days, and yet we seem to have so little time to be able to do it in. So we started out the program by discussing, the big presidential election. We had an amazing turnout of voters in America. We had an overwhelming response in the popular vote, electing the 45th president as now going to be the 47th president. And as with all presidential elections, we know that when you bring into office a different individual than the previous individual, you're going to have new ideas. You're going to have new agendas. You're going to have new initiatives that are being brought forth. And outside of the stock market seeming to react very positively to the presidential election and the results of the election, we know that there's several different things that are a catalyst. Number one, we look at the fact that Taxes are a big issue with Americans. So many Americans feel as though they're being taxed to death. And when you're a small business owner, you feel that kind of even double more so because you're paying your taxes, plus you're paying the taxes on your employees. And there's so many various different little things that you're paying. And it feels like at the end of the day, you're just getting the crumbs that are left over from your hard work. Now, also, we have to be thinking about the Federal Reserve. The Federal Reserve has cut interest rates not once, but now twice. And that is fueling this idea of we're going to start to see the stock market really begin to potentially blossom. We're going to see the economy pick up. Now, on one hand, that's great, right? We all love to see expansion. We love to see our portfolios increase and go up, but we also have to be a little bit cautious, don't we? Because we've seen this before, where the market grows and it grows and it grows, and it seems as though there's just absolutely no end in sight. And yet we know what's happening is the bubble is getting bigger. And so we have to be careful of that, because we've seen that not once, but we've actually seen that twice just since the turn of the century. And when that bubble breaks, if it ever did, which we all know that history tends to repeat itself more often than not, we have to be very careful because, well, let's face it, we've seen a 50% loss not once, but twice. And this close to retirement, the question becomes, can you really afford to have that experience? So what does this mean to us? Well, there's probably lots of good things that are on the horizon. We know that President Trump is more of a capitalist. We know he's more of a businessman. And in many respects, some could argue that we really need to get back to the basics of being a business and running the government as a business. We know that there's lots and lots of excess. There's lots and lots of waste that takes place within a government. And if we could get rid of some of those things, I think that that would be a good thing. Maybe make the government kind of live within its means like what you and I have to do. But regardless of what they do, or regardless of what they don't do, you and I have a particular responsibility to stay focused on our priorities, the things that we can do for ourselves. And so when it comes to this, I want to just have a frank conversation with you with regards to the market. I have seen already, just in the last few days after the election, where investors are now starting to take everything out of the safe, conservative areas of investing, and they've put everything in the stock market. And getting this close to retirement, I want to forewarn you that that is not a recipe for success. Now, granted, that's very different than just taking and increasing your stock market exposure by, say, 10 or 20%. But I want to just suggest to you that if we stick with the basics, if we continue to focus on where we're going, this is kind of, the Wayne Gretzky, I look to where the puck, not where it's going, not to where it's been. If we look at where we are headed as a person who is potentially working, we're headed towards retirement. We're headed towards that stage of our life in which we want to be able to make that transition from a paycheck to a playcheck. And so we know that what we've worked hard to save is going to be the resource in which we're going to be drawing from in order to be able to get that income. And so let's say that you want to be able, you feel optimistic about the stock market, as do I. And yet at the same time, you don't want to be silly about this. You want to be able to exercise some degree of judiciousness. Well, this is where we want to go back to the basics of investing in stocks that are going to pay us dividends. Good quality, dividend-paying, free cash-flowing stocks. These are things that allow you to do not just one thing, but they allow you to do two things. And if you've never thought about it, if this is the first time you're hearing this, I really encourage you to listen in. You see, when we invest in stocks, especially the older, more mature stocks, the blue chips, the dividend aristocrats, and we're doing it in such a way where we're investing in these stocks individually, and we've got a good diversification of stocks, and they're well managed. The reality is that not only can you experience the appreciation as the stock grows with the stock market, when things are going well, when optimism is running high, but you get to leverage that appreciation and that growth by taking and adding to it the amount of dividend that is being paid to you. So I just want you to think about that. Everybody wants to have, anywhere from 5 to 10%. Well, if we're really being honest, we want 25% every single year, right? But it doesn't exist. And so we want to be able to get that 5% return every single year. Well, what if you could leverage that 5% return by actually then compounding it with another, 3.5%, 4.5%, maybe 5% dividend on top of that? You see, this now gives you some really wonderful growth, but pay a careful attention. If the market declines, guess what? That dividend will allow you to have income to spend. It will allow you to have income that you can still maintain and have without taking and selling shares while they're down. And when you think about it, that makes all the sense in the world. I don't want to have to sell my asset, but I certainly don't want to have to sell my asset when things are down. And whether we see a stock market retracement when Trump is president or not, I don't know. Hopefully not. But the reality is it's always a possibility. So we want to make certain we're looking into the future saying, okay, well, I'm 70 today. I know in 3 years I'm going to have required minimum distributions. I'm going to have to start taking distributions out. Do I want that distribution to come at the cost of my principal? Or do I want that RMD to be coming out of interest and dividends where I don't have to sell anything? I also encourage you to be thinking about the fact that, when you are investing, you want good diversification. Having stock, having dividend-paying common stock, that's a wonderful thing, but it's not the only kid on the block. We have plenty of things that are more contractual in nature that are going to produce even more of an interest or a dividend income for you. Maybe instead of getting, say, 3.5 to 4.5 on average, what if you got 6.5%? How would that change your life? What would that create for you as a peace of mind? Now, why did we talk about the Federal Reserve? Well, I talked about the Federal Reserve earlier cutting interest rates, not for just the sake of the interest rates going down means that the stock market's likely to respond positively. But I also want you to think when the interest rates go down, the things that are more contractual, the things that are more fixed income, the things like the bonds and the preferreds and the business development companies that I talk about so often on this radio show, those things are going to go up in value. Now, if you already own them, that's great because that's an appreciating asset. But if you're just now starting to explore this idea of getting more income, you want to know that now is the time to make some transitions. Because as the Feds cut interest rates, those things are going to become harder to find on sale. As the Feds reduce interest rates, the value of those things are going to become more expensive. And that means the more you pay for them, the less of a yield you get. And you're far too smart for that. So now is the time to start focusing at least a portion of your portfolio on that income so you can get what you deserve. Now, we would be remiss if we didn't talk about the end of the year, because as the end of the year is coming, we've got all sorts of deadlines, right? We know the custodians, even though we don't end our year until December 31st, many custodians that have our money, whether it's Fidelity or Vanguard or Principal or wherever, we know that they have service work to do before the end of the year, and they certainly aren't going to wait until December 31st to do a Roth conversion or to do an RMD. They want to be able to get those service items taken care of before the end of the year so that they can be finished up and start the year fresh, just like you and I. And so I want to just throw out 3 things that I think are so very vital and important. Number 1 is the Roth conversion. Now, if you really believe that the stock market's going to be going up, and I think that there's a lot of evidence that would suggest that that is probably the case, well, guess what? Now is the time to do Roth conversions. Now, You want to do this the correct way. You want to do this while you're owning the asset that's in that IRA. You want to journal that asset into the Roth. Why? Because you're not selling it. You're not paying transaction fees. You're just simply moving that asset into another bucket. And by doing that, number one, you're going to pay the taxes on that Roth conversion. But owning that asset, as that asset continues to appreciate, now all of that appreciation within that Roth account is going to be totally tax-free to you. And that's the best kind of appreciation. That's the best kind of gain that an American can have. Now, number two would be, guess what? Planning for taxes. And how do you mitigate the income tax that you're going to pay in 2025 from the 2024 tax year? Well, too many of us are not paying attention to what we could be putting into our 401ks, what we could be putting into our 403bs. So remember, as average Americans, we're only putting in roughly about half of what we could be putting into those programs. So if you want to pay less income tax, what I suggest is you may want to consider stuffing those employer retirement programs with more money before the end of the year. I don't care if you're not even coming home with a paycheck because you're just shoving it into that 401k or that 403b. That's going to help reduce the amount of income that you report in 2024, and it's going to help you have less income tax in 2025. Now, as with all things, things must come to an end, just like this program. But I also want to suggest to you that we have to be thinking about, the idea of RMDs. And RMDs are one of those things that maybe Roth conversions are going to be able to help you because it's reducing down the amount of money that you have in that traditional IRA. But guess what? You can also just take distributions. So if you're maybe a farmer or business owner, you got a loss, take some money out of that IRA, fill up your income tax bracket, say at 12%, or if you're even further than that, you may not pay any taxes whatsoever on the withdrawal of the IRA. So all good stuff, so many things happening today, so little time to discuss all of it. But as always, I'm Matthew Johnson. Thank you so much for listening and watching to this program. And remember, it's up to you to make today a great day.